Hello all and welcome to today's webinar for Market Matters Invest. My name's James Gerrish. I'm the lead portfolio manager at Market Matters Invest. I'm also a portfolio manager at Shaw and Partners. And it's really fantastic to have so many of you on the line today. I'm going to introduce you very shortly to our other panelists today. But before I do, I'm just going to give you a quick overview of what we're going to cover today on this webinar. So we're going to give a quick overview of portfolio performance, the Market Matters Invest portfolios, which are our portfolios open for investment, launched around 12 months ago. I was the first to put money in it in January of 2022. So we've been going over a year now. The strategies have been going longer. We've been on another platform for over 5 years, but so they've been going for longer. So there's a bit more history to come on the back of that, but we're going to give you a quick overview of the performance. And then we're going to give you an understanding of how we're seeing the markets at the moment. We've obviously been through the reporting period, the interim reporting period here in Australia, and how we're positioning portfolios as a consequence of that. Some of the key takeaways that we got out of reporting. It was really interesting reporting, but there's some key learnings that we can take out of this reporting season that we use looking forward. Stocks that caught our attention. So everyone loves a stock pick. So we're going to give you 6 of those today and try and articulate how we, through sort of a practical representation of how we think about stocks and how we've moved stocks around our portfolios to give you an understanding of how we approach the markets. And then we're going to look at Market Matters Invest and opening an account, because ultimately that's what we're here to try and get you to do. On the line today, I've got Sean Hickman, who's our research lead, and I've also got Harrison Watt, who's another portfolio manager at Market Matters. So feel free to unmute yourselves and turn your cameras on, guys. I'll give you just a quick overview of both the guys. And one of the things that I think has been really important over the last 12, 18 months in terms of markets is having a really good handle on the macroeconomic dynamics, particularly in large cap portfolios. So we've got a large cap growth portfolio. We trade quite heavily in larger cap stocks. So the macroeconomic influence has been really big on those, and it's really great to have Sean on board leading our research efforts, particularly focusing on the macroeconomic dynamics that are impacting markets, and it's been really critical to us. So Sean's had 30 years experience in the markets, a great history of research and the like, particularly with a focus on macro. So it's really been instrumental in our stock picking over the last 12 months. So welcome, Sean.
Nice to be here.
And we've also got Harrison Watt on the line, portfolio manager. He's got I work very closely with Harry. He's chartered financial analyst level 1. He's our emerging company specialist. So we're going to hear a lot about the emerging company space or some picks in that space today. So Harry, welcome.
Thanks, James. Thanks for the intro.
And then we've got, not on the line today, but Peter Winty and Peter White, who are investment committee members. They're instrumental in the investment strategy that Market Matters employs. So we lean on the experience of those 2 guys pretty heavily. So that gives you a sense of the investment team at Market Matters. Before I begin, just a quick disclaimer that any advice provided on the line today is general in nature only. You should consult a financial professional before taking any of the information on board. So that is important there. In terms of getting underway, so the Market Matters Invest platform, I'm just getting a little bit of feedback on the line. Is that maybe you guys need to be muted when you're not speaking, otherwise I'm getting a little bit of feedback. I just wanted to give you a quick overview of the Market Matters Invest platform. So the Market Matters Invest platform provides you access to a really, it's a digital first investment platform that we call it. You get access to an app. It gives you really interesting insights into the performance of your portfolio, digging into the stocks that you actually own in your portfolio. We provide regular reporting on the how we're seeing markets, how we're positioned in markets, etc. So it's a really interesting app. So I'm not going to focus too much on that area today. However, there is a webinar that we did, or recording of a webinar we did 6 months ago, that really gives you a step-by-step process around the platform. We give you a tour of the platform and a better understanding of how the platform sort of underpins what we're doing in Market Matters Invest. So we'll put a link to that in the recording that we send to those who have been on the call today. Performance for the Market Matters Invest portfolios. So each month you will get if you're invested in the portfolios, you'll get a monthly report. We'll actually put those who are also interested in investing on the monthly report. It gives you an understanding of how the portfolio has been going from a performance point of view. It gives an understanding of our rhetoric around stocks that we hold. They're reasonably high conviction portfolios. So the active high conviction portfolio is aligned with our flagship growth portfolio on the Market Matters website, holds around 20 positions. It's high conviction in nature. In January, we did 8.18%. It's ahead of its benchmark in all time frames. To give you an understanding of where we're at the moment, so just in terms of the updated performance as at the end of February, so financial year to date, we're up 20.28%, which is about 7% above the index. So it's been performing very well relative to the index. Of course, we're all about delivering consistent returns. So that's what we want to do over time. So if I look at the 3-year track record as at the end of February, we're about 10% per annum, which is about 3% above the index. In terms of the active income portfolio is more of a, as the name suggests, focusing on income, but it holds equities as well as hybrids and other fixed income securities. So it's potentially lower return, but it's certainly lower risk and lower volatility. So it's over time, it's had about half the volatility of the underlying equity market and delivered. It's actually outperformed the broader equity market, and it's outperformed its cash plus benchmark. So that the benchmark of that is the RBA cash rate plus 4%. So it's done particularly well, and it gives you a really clear understanding of, or a really clear understanding each month of how we're positioned and what we think of the stocks that we're holding in the portfolio, what's contributing to returns and the like. So it's a blended portfolio, as I said before, high yielding Aussie equities as well as listed ASX hybrids and other fixed income securities. Has about 20 stocks in the portfolio, positions in the portfolio, and you get to understand that how, in these monthly reports, you'll get to understand how the performance has gone in terms of the monthly performance. So it gives you an idea of how much volatility you can expect in each portfolio. So if I'm thinking about risk, I'm thinking about the active high conviction portfolio as moderate risk. It's an actively managed large cap Australian share portfolio managed primarily for growth. The active income portfolio is the lowest risk of the three. It's a blended approach, has lower volatility, has higher yielding sort of circa 6% at the moment. And then we go into our emerging companies portfolio, which is a higher risk, higher return. Hasn't been around as long as the other two portfolios. Again, it's tracking ahead of its benchmark from inception. It's had a bit of a rocky road on a 1 year and 2 year view, but it's had a really strong, more recent period. And also, you've got to think about the backdrop of emerging companies over the past year or two. They've been pretty challenging. So that portfolio is a really good addition, but it's a higher risk, higher volatility portfolio. I'm going to crack straight on in terms of what we saw in earnings season, because I think it's really, this is where the rubber hits the road. Obviously, everyone's looking at how we're positioning in markets, and I'm going to shoot across to the guys just quickly. Sean, from you, just the overall feeling. I'm going to get into some of the data and the positives and negatives that I saw, but just a couple of feelings from you around reporting season that you witnessed.
A couple of things, James. We're seeing the same sentiment that we've seen over the last year or two, and that is good is good, bad is bad. If someone's missing, we're not in a bull market. We're not in a market when everyone's just trying to buy any dips in stocks. So if someone misses, those stocks are tending to fall for a while, and we should be very conscious of how the market's interpreting the result, whether we like it or not at Market Matters, because if it is a miss, and it is a miss on guidance going forward, the likelihood of the stock will underperform for more time than it would have done, shall we say, 5 or 10 years ago. That's the first thing. Nothing new there, but something to be very conscious of. The second thing is, it doesn't matter who you are. I think we've seen that loud and clear this time. It doesn't matter who you are. Two of the biggest disappointments, BHP and CBA. Couldn't get much bigger in terms of names for the Australian market. CBA is well up, dropped about over $10 from its high. Sure, it's paid a dividend in that time, but it's a significant pullback, and BHP as well. Not awful results, but people have been long these stocks for a long time, and they've come off because they weren't quite as good as people wanted.
Yeah, I think that's a really good point. They were not awful results at all. I think they were. If you look at the results by them, on their own merits, they were really strong results. It's just the fact that there was a lot of optimism built in. CBA was trading at all-time highs, and BHP was up near $50. So a lot of optimism already built in. Harry, I want some really interesting emerging companies insights. You meet a lot of companies, you speak to a lot of management teams. What are some of these little things that that you got out of reporting?
Yeah, definitely, and particularly during February, we're speaking to about 3 or 4 companies a day. It feels like at the moment. One thing that came out of a meeting yesterday in particular was just the bullishness of a lot of retail landlords at the moment. We spoke to a company that's got about 140 sites in shopping malls around Australia, and they're basically saying that landlords are happy to just push on 10% price hikes for their rents at the moment. So there's a lot of pessimism out there on landlords, but in terms of what they're seeing and what the retailers themselves are seeing, they're seeing a lot of pressure from landlords at the moment in terms of raising those rents and those lease agreements across the board, really, and a lot of pressure on retailers as a result there if you've got a large store footprint. But at the moment, we didn't really see it in terms of moves in property stocks over the reporting period. There was actually a fair bit of downbeatness we've seen there, and I think a lot of that has to do with increasing rates and how that affects their balance sheets and their costs and the like. But drilling down to what their actual business is at the end of the day collecting leases, and they're pushing through massive price hikes. You can
CPI,
see CPI is 7.5%, and they're pushing through 10%. So they're sort of doing CPI plus 3% at the moment, and that's huge. And I think that if they can push those through and they can keep their sort of leasing levels where they are, that'll be massive for property moving forward, and probably downbeat on retail as well.
Yep. Nice insight there. So, from my standpoint and just bigger picture on reporting, obviously increased clarity always comes from reporting. And I think, we write a lot about company results in our Market Matters reports during reporting, but it does give us a great sense of where the broader market is, the broader economy is doing, and how the interrelated parts work. So what one company is seeing and what other companies, and you can put the puzzle together. There are pockets of some in the consumer. So there was this I guess misconception that all retailers were struggling. That's not really the case. We saw some pockets of strength and some pockets of weakness. Big ticket items are struggling. Smaller ticket retailers are doing quite well. So that was one of the things. Easing supply chains are obvious. Labor shortages are starting to turn, but we're still seeing a lot of upward pressure on labor costs, which is feeding into inflation. Then I spoke to CapEx intention. So you hear from a lot of companies who are still prepared to spend money or still planning to spend money. So it didn't seem to me that the reporting was as dire as perhaps some were expecting going into it. That said, there is an acknowledgement that conditions that we've just been in are probably better than the conditions we're going to go into now. Housing market remains soft, and there's broader ramifications around that, just in terms of retail sales, building products and the like, and then the labor pressures that I spoke on. But overall, we have seen, so we come out of reporting season, and this is what analysts have done. So we've seen cuts to estimates through the February results by the tune of about 0.7% of FY23 EPS. So that puts it in the context. So collectively, consensus has reduced EPS expectations by 0.7%. It's now for growth of 6.6%. It was for growth of 7.3% year on year. So leading into this reporting season. So there's been revisions lower, but it hasn't been hugely material. I spoke to the macro environment. Previously, and how that is playing into things. Sean, the insight that you give us on a macro from a macro standpoint has been exceptional. We had a lot of feedback about how good our macro calls have been, and that is largely down to the grunt work that you do in that space. The first we're looking at is I've put here mindset, but it's really around having an open mind. And you didn't want me to put that, by the way, but I'll put it anyway. Putting around, how we should think about recessions. We're all thinking about and reading about a recession, but how should we think about it? And what's this chart telling us?
Well, I think we should, personally, I really believe a recession is an opportunity. Markets deliver opportunities all the time. So if we go back over the last 30 years, the ASX 200 has delivered about 10% per annum. So if you're a long-term investor, every time it pulls back 10%, it's fabulous. It's time to buy. It's not time to get scared. It's not time to read the newspapers too closely. So I put that chart up there. The green circles are quite straightforward. They are the last three recessions. Normally the share market bottoms about 6 months before the worst of the recession, etc. So the market at the moment, as we all know with the S&P 500, is building in a recession. People are thinking we're going to get a recession. No one's quite sure how bad it's going to be. What I'm saying is, doesn't mean throw in the towel. It doesn't mean we should be running away from equities and sitting in cash. Historically, that's a shocking investment. So if we look at this, we saw it in December. We went limit long the market in December, and we had a huge rally in the market. We've actually pulled back and gone quite heavy, I should say, 18% into cash now, because we just feel the market's a bit more balanced. So I think we have to be open-minded, or mindset, as you've used there, James, but be open-minded. This market is going through a lot of cycles in a very contracted manner, and they're going to give opportunities. So just because we're going to get a recession, probably, maybe, depends what mood the RBA and the Fed are in that time, how they're trying to beat inflation. It's great. If they're going to knock share prices down of good, solid companies that are making money, then it's great. It's an opportunity to be a buyer.
I would caution that, and I would add to that in saying one of the things that market matters, one of the things I hate in the market is this constant rhetoric about just buy good companies whenever they're cheap, and buy. There's a lot of newsletters, tip sheets out there that that's what they push. We're not about that. What we're saying here is that opportunities will present themselves. You've got to have your finger on your pulse, and you've got to work hard to identify those opportunities and have a view around the macro backdrop. It's not as simple as just buying dips in stocks that the name of, which is pretty much what a lot of our competitors out there suggest to do. So totally agree, Sean. It's about having an open mindset, and that was the key to that chart there. But it's about doing more work than that.
Absolutely. I'd add one thing to this, James. It's a phrase I use a lot in the reports I write with you, is we have an elastic band effect in these markets. Optimism and pessimism, the elastic band is stretching a long, long way. So whether it be any stocks, whether it be the building stocks, we bought James Hardie after it dropped 50%. A lot of people would say, James Hardie, what are you buying that for as the building downturn is so severe? But it's still, what is a company worth? And that's the key. What are these companies worth? Where's the risk reward? So
I've got a good example of that, Sean, very shortly in a stock pick coming up. After we finish the macro, we've got the RBA cash rate versus the Aussie 3-year bond yield on the screen there. Subscribers of ours will be sick of us talking about the influence of bonds, but they're simply so important, aren't they?
They are at the moment, and there will be another period of time. And we saw it a few years ago. It was all about COVID, what the latest COVID numbers, et cetera, et cetera. Again, market goes through cycles. Those cycles in the macro front often last for years. At the moment, we are in a bond market cycle. And we have to all stand back. People of my age will remember mortgage rates, 15, 17% around the 1990s. The first house I bought had a mortgage rate with double figures. So today, we've got a situation where interest rates have bounced sharply, albeit only to 3.5% or 3.35% for the cash rate. We may well have seen a lifetime low for interest rates. That's fine. None of us don't fully understand. But what we should put in perspective here, if that's the case, we've had an 18-month outperformance by value stocks over growth stocks. That could just be the start. So our view at Market Matters is we are probably going to go to, or we believe we're going to go to, I should say, into a bit of a super cycle for the resources. And that means that the value stocks will outperform for years over the growth stocks. So just because they have for the last 18 months doesn't mean it can't for the next 5 years, because over the last 40 years, it's been all around growth because interest rates have been so low and going lower all the time.
So earnings are going to be really important. So gone are the days of buying companies on a revenue multiple, and it all comes down to earnings would be the takeout that I would push onto that. So bond market's still here. So this is about the ASX 200 with the 3-year bond yields overlapped. I'm taking it here, just again reinforcing the influence on markets that bonds have at the moment.
I am, and it's a bit of a messy chart, and for that I do apologize. But really what I'm trying to point out to people that over the last 12 months or 9 months, I think on this chart, we've seen that Australian 3-year bonds have nudged around this 3.75% on about 3 or 4 occasions. And every time they have, the ASX 200 has been well and truly under 7,000. So today we've got 3-year bonds nudging towards that area again. And it's one of the reasons we have reduced our cash position, or I should say increased our cash position, migrated down the risk curve slightly, because if interest rates are going to stay up there for a bit longer, even though we don't believe they will stay there medium time, it will give a better opportunity for some of these stocks, in our opinion. So the market is just been driven by sentiment around bond yields. Very, very clear.
Alrighty. In terms of cash, when we're talking about cash in portfolios, we often talk about each portfolio has a different cash weighting. So we've got a flagship growth portfolio that we publish on the Market Matters website, which is probably the pin up that we use. And that's what we're talking about when we're talking about cash at 18% at the moment. And then putting the puzzle together, Sean, you've got another chart here is around the US dollar. We speak a lot about this in reports with the 2-year bond yield there as well.
Exactly. I mean, financial markets are like a mosaic or like a jigsaw puzzle. They're being driven at the moment by bond yields. The secondary part of that is US dollar. So the US dollar has rallied very strongly over recent years because the US interest rates were going higher. It's pretty easy to see that there. But we only got a bit of a sniff of it coming off in late 2023. And we had a huge pullback in the US dollar. Didn't get much of a pullback in the US 2-year bonds, but that was because markets started to think we'd reached a pivot, a top for bond markets, or a bottom for bond markets, a top for yield. And the end result on stocks was we saw a huge rally in the gold stocks and a solid move up in some of the resources, copper, etc., because these commodities are denominated in US dollars. So when the US dollar is weak, it's very, very bullish for gold. And that's what we're saying here. If we're right, we're going to see the US bond yields come back. The US dollar is going to probably peak for quite a few years, in my opinion. And that means that gold could actually have a very strong move over the next few years.
Gold, copper, we're constructive on all the commodities. We were writing at the back end of last year that we were concerned about the overcrowded nature of that trade. So everyone you speak to was bullish on commodities, and you often get weak longs that get pushed out of the market, and that's certainly what's happened in BHP is an example there. But over the medium term, we're really constructive on commodities, and a couple we'll talk about when we dig into stocks very shortly. I'm going to kick it off with we're going to focus on some of the stock ideas that we've got at Market Matters, and these are typically stocks that we own. It's designed to give you an understanding of how we think about the investments that we're adding to our respective portfolios. The income portfolio holds Dexus, which is largest office landlord, I should say, in Australia. We've held it twice. We made money on it the first time, and we've just bought it again around $8 for the Market Matters active income portfolio. It comes down to what Sean was speaking about before, is how bearish the market has become on office. You might put your hands up and say you're ludicrous buying an office landlord given the uncertainties, the complexities that are playing out in the office space. These guys are trading, and it comes down to what's priced into the stock. So this is trading at a 35% discount to the value of their assets, the underlying assets. We're seeing transactions in the unlisted space happen at a 5 to 10% discount to carrying values. So to me, that gives us a big margin of safety. We think occupancy levels have remained high, and high quality office, these guys have got some of the highest quality office in the country, is going to remain strong. We haven't seen, when they reported recently, office values simply haven't declined, but Dexus is priced for a decline. It's trading on about 12.5 times, which is about 15% discount to its long-term average. It yields about 6%. So we think the asset value, the share price is trading well below the asset value. It's trading cheap on an earnings multiple, and it's yielding 6%. So to me, you buy those when the market gets really pessimistic. We'll be a seller if the market gets too optimistic on it, but I think that's one of our, it's certainly one of the core holdings that we've got in the Market Matters income portfolio. We really like it. Not a lot of people do like it out there because the rhetoric is not it's not the positive rhetoric that everyone would want to hear. But it goes to show we're happy to go against the grain at Market Matters, even when it's not a well-liked sector of the market, or it's got some warts on it. It comes down to pricing, and we'll never be scared to write our views around stocks that are unpopular. A stock that was popular then became very unpopular, Harrison, is Aussie Broadband, ABB. You've got it in your emerging companies portfolio. Why have you got it there?
Yeah, we're down a little bit on this position, Aussie Broadband, but we continue to like it. And I think coming off this reporting season, we continue to like it even more based on their report we spoke about earlier. Sean mentioned that it's earnings, and yourself, James, mentioned that it's earnings that should be driving where stocks go here, and Aussie Broadband have beaten on earnings. So their revenue might have missed a little bit, and they guided their revenue lower, but they guided their EBITDA higher. And I think that's what matters in this business. They're obviously a telco. They're out there selling telecommunication services to residential sites, to retail, to enterprise as well. And they're seeing a massive uplift in margin coming on the back of their over-the-wire acquisition last year. So that's really reset the business and reset it in terms of, now they're actually going after, making money, which is very important for companies, I guess. But Aussie Broadband have shown that they can do it. And they're pretty confident to go out there and put EBITDA guidance out. I'm not sure there was many great deal of companies in this reporting season that gave firm guidance. Aussie Broadband gave firm guidance and upgraded it from their previous numbers too. So really like the stock. I think this move that we've seen on the back of their reports, the start of things for the next little while for these guys. And if you talk about the telco market in general as well, you can start to see Telstra and TPG, they're lifting their prices across the board. We're starting to see more rationalisation in the telco market. And that will help a player like Aussie Broadband, which is it's the fifth biggest telco in the market at the moment. They're winning market share because of those price hikes. They'll follow those larger bulge bracket telcos as well and continue to see those margins improve from here, I think, James.
There's a couple of things. I'll dumb it down. There's a couple of reasons why I like this company. The management manage this company like it's their own. So they manage it like owners, and that's really important. So a real focus on earnings and a real focus on driving margins. These guys are going to grow earnings, if consensus numbers prove correct, at 20% average over the next 3 years. They're trading on 16 times. There's some things that could also give them an uplift there. So that could prove conservative. They're not just going out there to win revenue or sales for sales sake. And that's what we spoke about in terms of their, they've got a real focus on earnings. I think that is what the market's going to start to focus on in the not too distant future. So it's the biggest weighting in our emerging companies portfolio. As Harry said, we're down a bit on the position, but we continue very much to like it. A couple of big stocks on the ASX, Sean. I'm going to revert to you on this one, ANZ and CBA, because this was a stock call that we probably an unpopular one, but we sold CBA pre-result, pre-dividend, and moved into ANZ. Why did we do it?
Great question. Obviously, sacrilege. Sell CBA. We've been looking at the CBA ANZ elastic band, to use that phrase again, for quite a few years, and it's not hard to see there that a lot of people have been talking this for quite a few years, and it's proved to be wrong. It's proved to be premature. They've gone way too early. However, we looked at it in February again. I mean, it's not something we don't look at almost weekly, but we looked at it in February again. Let's put the factors together. ANZ was trading about 10 times below its normal, not 10 times, sorry, 10%, I should say, 10% below its normal valuation, medium-term valuation. CBA was trading 9% above its medium-term valuation. Plus, of course, for good measure, ANZ yields about 2%, 1.5%, 2% more. We felt that 20% or 19% differential between their medium-term valuations plus the growth factor going forward was enough to say, okay, right here, right now, ANZ is too cheap. CBA is too expensive. We made the switch. Really simple numbers.
Exactly right. You can overcomplicate things in the market a lot. So if I'm dumbing this down, I'm looking at, so you have an understanding of why CBA trades at such a premium to the sector. And there's a whole bunch of reasons, but it's a better franchise. It's got better technology. It gets better return on invested capital. It's a better run business. So, and it's bigger. It's capped at about 180 billion. ANZ's capped about 70 billion. So it's got scale. So there's a whole bunch of reasons why it should trade at a premium to the other banks. But when, that, as Sean made mention of, that elastic band became too much, and there's a chart I'll show very shortly. So to Sean's point around relative valuation, so this is taking as at today. So ANZ's trading at about 10 times, which is about 15% cheap versus its 5-year history. Why is it that cheap? So you've got to ask that question. Why is it cheap? Well, their capital allocation policies been mediocre, to say the least. They've made some really bad acquisitions, but they're changing that. So they've simplified their business. They've moved out of their Asian expansion. They've simplified their domestic business. They've got themselves into a good point, and now they're going for growth again. So they're going for growth in the mortgage market, and they're going for growth via acquisition, and they've bought Suncorp Bank, which has been doing particularly well, and I think it's a great acquisition. So they're cheap. Plus, they've got some drivers to be, to come back more towards their historical average multiple. And then you look at CBA. So CBA is obviously, everyone thinks it's a fantastic bank, and it is. But you see in their results when they just delivered, there was a slight undertone of weakness in their results, and it came in the net interest margin of 2.1%. But it peaked in October, and they were talking to increasing competition, which is taking away some of the benefits of the margin expansion they get from higher interest rates. So just that one tiny thing in the result saw the stock get whacked. So when things go too far on either side, the elastic band can be quite aggressive when it sort of reacts back, and that's what we did in terms of ANZ into CBA. So the relative performances work for us at the moment. We think ANZ is by far the best pick in terms of valuation, plus a catalyst for that valuation to change from here. So we're not super bullish on the banks, and because that will be shown through our weightings in our flagship growth portfolio in particular, we're underweight the banking sector. But overall, from a relative standpoint, we think ANZ really stacks up relative to CBA. An unpopular call, but that's how we see it. In terms of coal, and this is, did you want to add anything more there, Sean?
I was just very quickly going to say, CBA is the most expensive bank in the world. So
but it's always been that way.
Absolutely. And it's not something I'm going to hammer home. But the point is, as you said, when there are glimmers of peak earnings coming through or peak margins, there is a quick 10% coming out of the price. And that's exactly what we saw. We're not expecting CBA to fall apart by any means. We just feel like from a risk reward point of view, ANZ will outperform.
That's really important. So when something is so fully priced, even though it's a great franchise, a great business, a great operation, it's risky. It becomes more risky when it's, when it's so fully valued. And I think you've got to be in this sort of market. That is what active management, and that's what our active management is trying to accomplish and trying to achieve with, logical interpretations of relative value in the market. And ultimately, that's what we're trying to do. In terms of coal stocks, have obviously been really topical. The coal companies have had the best performance of any stocks in the market in 2022. Whitehaven Coal was our best performing stock last year in our flagship growth portfolio. We sold it a bit early. We're back into it now. I'm focusing on New Hope Coal at the moment. We've got this in our income portfolio. We've bought it very recently. But to give you just a quick understanding of what happens in the commodity space, and I'm using this as an example because normally you say you buy commodities when they're on a high PE and you sell them when they're on a low PE. So New Hope is on 3 times earnings, and it's going to yield about 9%. The reason why you would normally sell commodity companies on a low PE is because low PEs mean they're earning a lot of money, and they're earning a lot of money because commodity prices are high at the time. What happens when commodity prices are high? It incentivizes new production to come on stream. New production increases supply, and ultimately that means that commodity prices fall. So that's the normal flow of the cyclical commodity markets. What's different in terms of the coal market is we're not going to see that new production come online for a whole heap of reasons, whether they be environmental, political, and the like. They're well documented. I'm not going to go into whether or not that has merit or not. I think we need to. We're all moving towards a more environmentally conscious future, and I think that's a great thing. But in the short term, there's money to be made here, and I think that's our thesis on coal. Coal prices have rallied up to about 400 a tonne, and I'm using the Newcastle futures contract here. They've pulled back to about 200. 400 probably wasn't the right price. 200 is probably not the right price. Somewhere in between is probably the right price. But if it stays that way for longer, and that's our thesis here, that because there can't be a supply reaction to high prices will remain in the market for longer than anyone expects, and that's going to provide us an opportunity to bank some really great profits on these positions and get paid strong dividends along the way. We own Whitehaven Coal in our flagship growth portfolio. We've just added to both of these stocks as well, so we're happy to buyers of these companies here, and that's basically our thesis around the coal space, and it speaks to our thinking about commodities more generally. Anything else to add there, guys, or have I covered it off very well?
You're forgetting we do own Bowen coking coal in
in
the emerging companies portfolio, James. It's a little bit of a different story though, but given coking coal versus thermal, but at the same time, this is a pretty great company that's building up their production profile. They've had some issues with weather, but moving forward, I think that's a pretty good spot to be. And that thermal coal price usually trades at a discount to coking, and we haven't seen that for a little while. That's starting to revert a little bit, so a bit of a tailwind there in that coal space for Bowen as well, James.
My apologies for missing out Bowen. I own that stock, and I'm bullish on it. Let's move on. So Sandfire Resources. I'm sick of hearing my voice, Sean. So Sandfire Resources. I'll give you a bit of a background on the copper company. Actually, you go first, and then I'll come in after you, because I've got a few thoughts around this.
Okay, I've actually made some notes on this one because it's been a heck of a journey for Market Matters. But this shows how, as a business, we're happy to accumulate stocks we like into weakness. In other words, we're not out there trying to pick the top or pick the bottom. When these elastic bands go too far, we will start accumulating or selling in both directions. And that's exactly what's happening in Sandfire, with a bit of lucky spice at the end of it. So we started buying originally in October. We put 40% into it October last year.
4%.
4%. That's right. 40% would have been a bit much. 4%. And I'm talking now, before James corrects me, I'm talking now for the flagship growth portfolio, because we have also got this in the emerging companies portfolio, which
I think Harry bought it better in the emerging companies portfolio than we did in the flagship growth portfolio. He was into it around 370 a share earlier on. We didn't, because we owned Oz Minerals in that portfolio, in the flagship growth portfolio. Anyway, continue on, Sean. I digress.
Exactly. Okay. Well done, Harry. Anyway, so we put 4%. I stand corrected in October. We topped it up in November. Quite simple rhetoric. We felt the copper price was set to rally, which it in fact did. We then got a bit of luck when the company decided to raise money, and we were able to take up more stock at a 10% discount to where it was then through the share purchase plan, roughly what equated to 0.57% on our holding, took us to a 5.57% holding in Sandfire in the flagship growth portfolio. We were buying it slightly higher than we'd got in, but it was, as I said before, 10% below where it was. So we suddenly found ourselves holding a company we liked, that was making us a lot of money on paper in a sector we liked, but it had become a very large holding in terms of the overall book of, or the overall portfolio, I should say. So when the stock really squeezed higher, and the chart shows it there, unfortunately on my chart, our faces are all hiding the top of it, we started to take some off the table. So we took some off the table in, I'm just confirming the, in mid-January, we took some off the table. And when then we did so again above $6 so we did it the first time in mid-January, I'm sorry. And then we did it again in mid-December and then mid-January. I'm getting tongue-tied. My notes aren't helping me. So we've now gone to 3% Sandfire. So the bottom line is we are still, as James alluded to earlier, we're bullish commodities. So we felt the stock would have a pullback. It's had an aggressive pullback from those mid to high $6 region, but we didn't want to lose our position, our exposure to copper, because I'm one of the older of the three here, or I am the older of the three here. And
by a long margin, I should add. Yeah.
I wouldn't have said that. There are lies, and statistics. But the point is, over the time that I've been in the market, which is over 30 years, some of the biggest mistakes I've made, I've been not holding stocks for long enough that have been trending with me. And we believe that the copper goes a lot higher in the coming years. So we didn't want to lose our position in Sandfire. Now, as James said as well, we also had a position in Oz Minerals. BHP's come in for Oz Minerals, and we had a great win there. Again, a bit fortuitous that they did. The position was still making good money before they did, because Oz Minerals is a quality copper play, which we were happy to own for quite a long time. So what I'm trying to point out here is it's a journey. We accumulated into weakness. We trimmed into strength. We took the share purchase plan along the way, but we're staying core long Sandfire because we believe copper and the resources will go higher in the years to come. Whether we add to that into weakness, which may or may not come, or whether we go out elsewhere, we've been talking about stocks like Min Resources or South 32 I particularly like. Time will tell. Will depend on where we see the valuations at the time. But that shows you there are journeys within our positions and our mindset. It's not just purely buy here and sell here.
And that's important around when we speak about active management. So active management is not about trading. It's about managing positions in the portfolio on an active basis. So as markets evolve, we're evolving our thinking around the portfolio. In terms of Sandfire, so I'm a little bit more, I often talk to the guys about how we view the market. So we frame it as top down meets bottom up. Top down means the macro environment and how that's going to play into our thinking on stocks and sectors to own, but meets bottom up. So bottom up company research. And Sandfire, and Harry can no doubt talk to this because he's done a lot of work on this company around the operational improvements that they've had, the increase of their mine life. They had a lot of tough years, and Oz Minerals was simply the premier company. But they've had it at the time that Oz Minerals got taken out. Sandfire operationally were getting it right as well, Harry.
Yeah, it was a bit of a long journey. It's pretty important to note where they were when we did start accumulating that. There was a lot of fund managers out there really pretty dire on Sandfire at the time, talking about how their Matsas acquisition in Spain was going to be a bit of a troublesome one. If you think about how high energy prices were over there, how much of an impact that was going to have on Sandfire's balance sheet. We didn't think that was as dire as a lot of people thought. I think we got a bit lucky in terms of the European winter being a little bit better than a lot of people thought it would be as well. So the energy prices didn't quite have that impact on Sandfire itself. And now we're sort of coming out that other side. We've got a quality asset in Spain with Sandfire, and they're just about to start ramping up a new asset that they brought forward production on that as well. Actually, guidance they brought forward production there to the early start of fourth quarter, so only a couple months away as well. So it's another little kicker for Sandfire. Now that they're going to be the premier copper play on the ASX, I think they see a lot more love here as well. And like we say, we like the copper price going forward as well. So I think Sandfire, there was a lot of complaints about that one last year, and they've come out the other side and they're looking, really quality across a couple of assets and in a space that we want to own as well.
Yep. You got to have your own thesis out there. You've got to think independently and not follow the crowd in the market. And I hope that's one of the things that we're trying to push across in today's webinar. We've got one final stock, and this is in the emerging companies portfolio. It's Ordinate 88. Harry, why are we maintaining the love on Ordinate, which features in your portfolio?
Definitely like Ordinate. Another stock we own in the portfolio that reported really well. Really liked the numbers that are coming through. So Ordinate, they make some chips that go into speakers, and they now go into video systems as well. And they've got a software overlay on top of that that just allow this sort of digital connection between these audio visual products. And we think that this is a really important space to be. We're moving away from those cables connecting everything up, and Audinate are a sort of key player in this market. When I say key player, there's almost no other player in terms of what they do. They've cornered this market pretty substantially with it over 90% market share. They're in a space that's building as well. So Audinate, they've had their issues. We've seen they've had their issues trying to get supply of chips. Those issues are still around for them, but they're still managing to grow revenue. They're still managing to grow earnings as well on the back of that. And we see a really solid runway of demand for these guys for the rest of the 6 months of this financial year. They gave guidance that was really positive as well. So another company that we like in the emerging space that was really happy to put their hat on, on some numbers for the rest of the year. So a lot of visibility there. And I think that's why the market's a little bit more comfortable around Audinate here, and why we continue to like it. I think it's a stunning business, and they are expensive. There's no doubt. They're trading on a multiple of about 60 times EV to EBITDA. That's a massive number, but it's a massive opportunity, and there's really no one out there that is challenging Audinate in this space at the moment. And we see it as a key sort of holding near term. If it can continue to do what it's doing, we see this stock trading, significantly higher from here, and them justifying that multiple that they're trading on, which I think is important for the emerging company space.
Yeah, we spent a lot of time understanding this business, understanding the guys running it, so and understanding where they're taking it. So we've got pretty high conviction in terms of Audinate. That's all the stocks that we've got time for today. We are sort of 12:46, so we're going to wrap this up. I've got a few questions that have come through. Before I get on to your questions, I just want to give you an overview of just Market Matters Invest and where you can go to get more information and what it entails. So Market Matters Invest it's a digital first investment platform. You can access our 3 portfolios that we've spoken about today. So we've got the active high conviction portfolio, which is very similar to our flagship growth portfolio on the Market Matters website. We've got the active income portfolio, which is high yield Aussie equities combined with ASX listed hybrids and other fixed income investments. And you've got our emerging companies portfolio, which is really growth investments, searching out these emerging companies that are going to go and do good things over the coming years. You can open account types, and you can do all this online in about 5 minutes. Individual, self-managed super funds, the whole gambit of account types. You can open them for minors. So I've got my 2 daughters who have got accounts there. So they are very much getting into the swing of understanding the investment piece. The application, as I said, is online. The reporting is provided audited annual statements. You can drive the reporting function 24/7 online, so you can generate performance reports, income reports, franking reports, whatever report you'd like to get at your fingertips. As we say, the manager, which is Market Matters, provides monthly reports that go out to you to your inbox. You can see how we're thinking about things. They dovetail really well into a Market Matters subscription. If you invest more than $200,000, you will get a complimentary Market Matters subscription. They are aligned with our portfolios. They may not replicate them 100% because there could be some timing issues, but they're very, very close. There's a smartphone app. You can start from $10,000 and they're charged at 0.85% per annum. And that's all inclusive. So that's inclusive of GST, the reporting, the trading, the administration, all packaged up in a nice bow for you. And you can open an account online. In terms of the what we're going to send out from here for those who are on the line, we're going to send a recording of this webinar today to give you an understanding or something to go back and revisit. We'll include a link to our past webinar, which went through the platform in more detail from a detail perspective, and we'll add you on to the Market Matters monthly portfolio reports, so you get a feeling for how we're progressing on the portfolio. So please take some time to get to know it. That's what we're all here to do, trying to entice you to invest money with us. Thanks very much for listening, guys. Sean, Harry, thank you very much for giving us some insight on this webinar. I think and I hope that everyone on the line got a lot out of it.